All right, welcome to this episode of Market Shares. I'm your host, Tony Blodgett, and today we're going to talk about what I think is a misunderstood concept, but a very relevant strategy in today's market, and that is the buy down. And when we mention buy downs, there's really more than one thing that we could be talking about. And today specifically, I'm going to talk about a permanent buy down. I'm going to talk about a temporary, what we call 2-1 buy down, and what are the pros and cons of each of these and when might these be used. The other concept that we're going to cover is utilizing the seller's concessions or a seller credit in order to pay for these different types of buy downs. And this is being referred to in the market as a seller buy down strategy. So let me just start by talking about why it might make sense to even ask the seller to contribute towards the cost of a buy down. And then we'll get into what each of those buy down structures are. And look, this can be kind of complicated. And my goal today is not to confuse you, but to educate you in as simple terms as possible how each of these work and what are the pros and cons of each sort of an idea. So the first thing that we need to kind of set the stage for is what the market that we're in right now is kind of dictating that this might be necessary. And the reason for that is because what we've seen happen here over the last few months as interest rates have increased significantly, we have a couple things that are happening. The number one issue and concern that I see is it's really impacting affordability, specifically for first-time home buyers. And so we have a lot of people who have been priced out of the market. Now, I want to make it very clear that this, at least the temporary buy down strategy, does not help you qualify for any more of a mortgage than you otherwise would. And we'll unpack that a little bit more when I break down that strategy. Where a permanent buy down could potentially increase your purchasing power and allow you to qualify a little bit more of a home by getting that interest rate down for the long term. But here's the reason why a seller may be willing to do that is because if you look at today's market, we're seeing more standing inventory and we're seeing a lot of price reductions. Now, these price reductions don't always evidence to us that there is declining home values. It might just mean that people have not quite priced their home appropriately for the current market conditions. But what I want to illustrate for you is that it, in most cases, would make sense to utilize the seller's contribution towards a buy down of either a temporary buy down or long-term buy down in lieu of them just dropping the price. So let's get into this. So for today's kind of exercise, I'm just using some generic numbers. This is not an interest rate quote of today's interest rates per se, although, this is in the realm of what we've been seeing, rates in the high fives, the low sixes. Obviously, there's a lot of factors that will indicate what your exact interest rate is, but this strategy and these concepts I'm going to cover today, the specific interest rate isn't really relevant because the cost of the buy down and how much the interest rate moves in relationship to the final rate is going to be the same regardless of if rates are in the 4s, the 5s, the 6s, the 7s. It doesn't really matter. So for today's example, I'm using an interest rate of 5.875 and I'm using a purchase price of $600,000 and I'm assuming 20% down, okay? So in this particular case, you have a $600,000 house, and one option is that you ask the seller to lower their price by $10,000. So you offer them $590,000 for their home instead of $600,000. And in that example, if you stayed with the 20% down and the interest rate of 5.875, that would be about a $47 lower payment than if you just paid full price at $600,000 with 20% down and the same 5.875 interest rate. Now, let's talk about a 2-1 buy down. So a 2-1 buy down is a temporary buy-down solution. As I mentioned, this does not help you qualify for more of a home. It just makes the payment significantly lower for the first 2 years. So the reason it's called a 2-1 is because the interest rate, it's still at that same 5.875 that you might get on a 30-year fixed. However, you're going to prepay the interest for the first 2 years. And we're going to do that through a credit from the seller. So in this case, a 2-1 buy down costs 2.125 discount points. So 2 1/8 points. So on a $600,000 house with 20% down, the loan amount is $480,000. We'd be asking the seller to contribute $10,200 towards this temporary 2-1 buy down. And so what this would do for you is during the first year of your monthly payments, your interest rate would actually be 2 points lower than the final note rate. So the final note rate, again, in this example, 5.875. So therefore, the start rate is going to be 3.875, and you're going to make that monthly payment for the first 12 months. Now, the monthly savings on that is $582.24 for the first year, okay? The second year, the interest rate actually goes up by 1%. So instead of being 3.875, it's now 4.875, and then you make that payment for the next 12 months. And that's going to save you about $299, almost $300 cheaper than the payment at the full 5.875. And then at the end of 2 years, you are going to revert to the 5.875, and that will be your interest rate for the remaining 28 years of this deal. So essentially, you're spending 2.125 points to prepay the interest so that you can have a 2% lower interest rate the first year, a 1% lower interest rate the second year, and then you're going to stay at that fixed rate of 5.875 for the remainder and duration of your mortgage. So why would you do this? It doesn't help you qualify for more, but what it does do is it helps bridge the affordability gap. And what I see happening in our market right now is that the actual, amount of homes available, although there's a little more inventory, it's not like we created all of a sudden, the huge deficit of homes that we have didn't just pop out of nowhere. We don't have enough homes for everyone that needs one. And what also hasn't changed is the number of people, the millennials, that need to purchase homes. That first-time homebuyer group is still there. The challenge they're having is that interest rates have gone up so much over the last few months. They're having this kind of sticker shock, this affordability issue. And I believe that many people can qualify at today's interest rates, but you know what? They're just reluctant to do it because of their budget, and it's just so much higher than what they anticipated their mortgage payment could be. So what the 2-1 buy down could do is it could help you ease into this payment by giving you a much lower payment during the first and second year. Like I said, $582 less for the first year and almost $300 less for that second year. Now, the other thing that, many economists and many people, both in the mortgage and real estate field, as well as people who opine on our industry and the market, and really anywhere on the news, you can't help but hear that it's very likely that we're heading into a recession. And I've talked about this on this show a couple times, and the one thing that almost always happens during a recession is that mortgage interest rates come down. And so what we've experienced right now, and look, we saw this with COVID and the recession that happened when COVID hit, is that interest rates went down, and they were down for a very long time, and there's a lot of reasons for that. But what that did is, because the Fed's actions and the purchasing of mortgage-backed securities and the purchasing of U.S. Treasuries and creating the liquidity in the market, now we're dealing with the inflation that came as a result of that, and that inflation is driving up interest rates, making it less affordable to purchase a home, not to mention the sheer appreciation in home values that's happened over the last couple of years. So What we do know is it's very likely that as we move forward and the feds continue to slow down the economy, that will lead to a recession and interest rates typically come down. Now, look, there's no guarantee that if you do a temporary 2-1 buy down, that in 2 years from now, you're going to be able to refinance into a much lower interest rate. I mean, it's very possible, but of course, no one has a crystal ball, and you wouldn't want to make all your planning based on that. And this is not like a loan that's going to wildly adjust like some of the adjustable rate mortgages you saw in the past. Look, we know what the permanent rate's going to be. It's going to be at today's current market rate. You're just asking the seller to fund the interest for the first couple of years to make it more affordable, and with the hopes that you could potentially refinance and get into a more permanent, lower interest rate long-term at some point around that 2-year mark. So this is a great strategy to at least understand if you're a loan officer and consider if you're a buyer. And if you're a real estate agent and you might want to put in your listing that you're offering this. Now, you have to partner with a lender that offers this program, and the 2-1 buy down isn't the only temporary buy down strategy out there. There is a 1-1-1 buy down. There is just a 1-year 1% buy down. It's just a lower rate by 1% for 1 year. It's much less expensive than 2 1/8 points. But I'm not going to unpack all of those today. I just want to explain this 2-1 buy down because it's something we talked about years ago. And for many lenders, it's limited to FHA. But many lenders like ours, we can offer this on our conventional products as well. So that's the 2-1 buy down. Now, I think it's only fair that we mention a permanent buy down. So what if I took that same 2 1/8 points that we paid to fund the temporary buy down, and we use that to pay discount points to permanently buy down the interest rate? Now, this is not like an exact science, but for this illustration, I used an estimate of how much lower interest rate you might get. So using 5.875 as the example without paying discount points, if you were to pay 2 1/8 points, the same cost as the temporary buy down, you might get an interest rate down in the low 5s, 5 1/8, 5 1/4, somewhere in that neighborhood. Again, it's going to vary depending on what rates are doing on that given day. But for illustrative purposes, I wanted to use 5.125. So if you were able to pay 2 1/8 points and you got 3/4 of a point lower in interest rate, what would that look like? Because that's a realistic scenario, I think, like I said, give or take. Now, what that would do is it would lower your monthly payment by $225. So again, you're asking the seller to contribute 2 1/8 points towards a now permanent buy down. And in this scenario, your interest rate would be 5.125, and it would be that way for the whole 30 years that you, in theory, would have this mortgage. Now, $225 is a great savings, right? You're saving $225 a month. It's nowhere close to the $582 a month that you save with the temporary buy down, because that's getting you 2 whole points lower for the first year. This is getting you just 3/4 of a point lower for forever. Now, obviously, there is a risk and reward payoff here. The temporary buy down is just that. It's temporary. It gives you a really big savings for the first year, a pretty good savings for the second year, still more than this permanent buy down. But then you're back to the 5.875 for the duration of your term. And if in fact rates aren't at a place where you can refinance, or something has changed for you as far as your income goes, your credit, or something else that makes you not able to qualify and take advantage if in fact rates do go down, now you have the risk that you're going to be $225 higher payment for the remaining 28 years, or for as long as you have that mortgage. So again, there's risk and reward here, and it really depends on what you think is going to happen with interest rates and the market over time. I think both of these are very viable options, and right now I think it's very realistic to be able to ask a seller in many markets to contribute towards your closing costs, or in this case, these buy down strategies. Now look, this is not fully inclusive, and look, there's a lot of benefit to have a seller just contributing towards your closing costs, as I mentioned, without paying discount points or doing buy downs, depending on your cash situation. And look, depending on your financial situation, maybe a price reduction could potentially be the right thing for you, because now you're going to owe less on that home. And if you can afford the monthly payment right now, and you think rates are going to drop in the next 8 months, 9 months, and you're going to refinance your mortgage, well, then maybe a 2-year buy down isn't the right strategy for you. But I wanted to kind of break it down this way because I hear seller buy downs talked about a lot in this market. And we also have a lot of real estate professionals reaching out saying, what are some creative strategies that we can put in place that are going to help bridge this gap that our buyers have around affordability? And you guys, this strategy is really about targeting that first-time home buyer and helping them feel more comfortable with the sticker shock of what that payment's going to be, at least for their first year of being a homeowner, because I think it's keeping a lot of people on the sidelines, and there is some really cool strategic options out there that you might be able to utilize to help out your clients. And if you're a home buyer, this might be just the right thing for you. If you're looking to get into a home today, you could technically qualify for the higher amount, but man, your personal budget just has you really concerned. This might be a great way to get into it. You know, the other great thing about a 2-1 buy down is if you're in a financial situation where you expect your income to increase over time, maybe you're on a new job and you know that there's going to be some raises coming based on your contract or your agreement with your employer, etc. Using the seller's funds to give you a temporarily lower payment, and then as the payment goes up, you're in a better financial situation to be able to afford that. That might be a very good reason to consider this. Even if you think your overall household income is going to change, maybe one spouse isn't working right now, maybe you have a young family, but you know that that second income is going to be returning in the future. Another great reason why you might consider something like this. So look, my goal with this podcast is to share different market strategies with you. Also, of course, we have a lot of fun interviews here in the studio with different unique people that you can learn from. But, you know, I have some more ideas like this that we're going to talk about in the coming weeks and months. Just creative ways of putting together kind of out of the box financial structures that maybe were things that we did quite a bit in the past and we hadn't really considered because of the most recent market conditions. So anyways, I hope you enjoyed this. I'm going to do my best to put some graphics up on the screen as we go through this that are going to do a good job of hopefully explaining what this looks like in real numbers, because it is kind of complex to follow. But you guys, if you have questions in the comments down below, go ahead and leave them. I'll do my best to clarify, or reach out to me directly if I can help you in any way understand these concepts, or if you have a client that needs to better understand these, just reach out. That's what we're here to do, is to educate. So with that, this has been the Buydown episode. If you enjoy this type of content, please subscribe to our channel. We really want to grow the number of subscribers because it allows us to do more things with this page and reach more people. So share it with your friends and family. This is something I don't think a lot of people are talking about, and I think it's very interesting, specifically to those in the mortgage and real estate field. So help me push it out there. Help me get this message out. I'd sure appreciate your help with that. Until next time, I'm Tony Blodgett, and I'll see you on our next episode. Take care.